but you have something for us.
Yes, so the Nifty IT index is down 25% this year. It's the biggest sectoral losers in our market so far this year. Right now, the question that a lot of people are asking is that have IT stocks corrected enough? Should one buy into the downturn? The downturn may last for the next 6 months, 3 months, 9 months, who knows, right? But is it now presenting an attractive opportunity, or do you think IT stocks can fall some more? So first, here are the numbers. This year, Nifty IT index is down 26%. But bear in mind that it comes on the back of two very solid years. In 2020 and in 2021, the Nifty IT index gave you a return of more than 50%. Now, I'm going to present 4 cases why IT stocks could weaken from here on, and 4 reasons why perhaps you should buy into the downturn, and then you can decide on which side of the fence you want to be on. So this is the bull and bear case on the IT. So first, number 1, we are talking about the bear case, right? CY23 budgets. CY23 budgets could get cut. CY23 budgets which get fixed in January could get delayed. There is also a risk that this time the tech budgets may be short term. The companies will decide their tech spend only for 3 months, 6 months, not for the full year. And there is also a risk, right, that if a company decides that I'm going to spend 5% on my technology budget in calendar year 2023, but my company's performance deteriorates as the year progresses, so my actual spend will be a lot lower than what I had initially planned for. So there is that divergence. Point number 2, the big elephant in the room is the US economy, right? There is a very strong correlation between the Nifty IT companies' growth and the US GDP growth. So if the US economy gets into a severe recession, a severe downturn, and then we could see EPS cuts. This is the Credit Suisse analysis. They're saying consensus expectation right now for FY24 is that the US real GDP growth is 0.6%. In that case, the Nifty IT companies will see a growth of 7.5%. But look at the bear case. If things go south and the US GDP growth gets into a deep recession, then the top line is going to get shaved off, and that will result in EPS cuts. Point number 3. Premium valuations. Despite the derating that we've seen, Indian IT companies are still trading at a premium to the kind of premium they command over the rest of the markets and the pre-COVID average. And point number 4, mid-cap IT could be vulnerable. And this is on account of 2 possible reasons. One, they have a greater concentration of dependence on their large clients. So if one of those large clients gets into pressure, then their revenues are disproportionately impacted vis-a-vis large cap IT companies whose revenue base is far more diversified. And 2, it's vendor consolidation. So this is the bear argument, right? But on the bull side, right, the bottom may not be formed just yet, but in the next 3 months, 6 months, things could get worse and one should buy into. So we are in the final stages of a downturn. Now, IT companies have been consistent wealth creators. This is the CAGR returns over 3 years, 5 years, and 10 years. And you would see on an average, these companies have given you returns of 20%. Now, TCS, Infi, these are very large companies. The TCS top line is $25 billion. These companies cannot be replicated in a year. These are companies which have proven themselves in the digital transformation wave that is currently ongoing. Point number 3, IT companies have seen 1 year of a time correction, and 2, they've seen significant valuation derating, right? So as I said, we could be in the final stages of an IT downturn. And 4th, the cloud adoption and migration is a multi-year tailwind. It can slow down perhaps in 2023, but it is something which cannot be reversed. So that is, the bull and bear argument for the Nifty IT space. Let's see how it performs. But back to you guys.
Rima, thanks very much for that very interesting